Ladies and gentlemen, welcome to our latest edition of the Fund Manager interview series. I'm delighted to be joined by Joseph Constable from the H&G High Conviction Fund, another one of our kind of microcap funds that we track in our performance database. And for those of you who know, we started last year with the Microcap Fund of the Year award for 2020, and the 2021 edition be announced in late January, when all the fact sheets and numbers and everything come together and I can collate it all. Joe, for people who mightn't be familiar with the fund, just give us a little bit of background on yourself and the fund, kind of where it's come from and the kind of companies that you would expect to find inside in it.
Yeah, sure thing. Thanks, Mark. And first, thanks for having me on this. It's a pleasure to be on this side. I'm a regular on the Thursday morning microcap session. So yeah, I really love what you do and great to be here. So just tell you a bit about the fund. So H&G High Conviction Fund, it's a wholesale unit trust and it's focused on microcaps, usually around $100 million market cap or less. And in terms of really what we're looking for, we're pretty agnostic in terms of the sectors. But the main thing really is companies with what we deem to be superior assets and underlying businesses, and also expert management teams who have substantial shareholdings and who really know how to run a business. So we're looking to find companies where others aren't on the whole, and that's why we love the microcap space, because as you know, these emerging companies are always a source of this abundant but under-researched businesses, and usually due to a lack of institutional ownership, and they may have insufficient capital. So we're happy to step in once we've done the real due diligence, and we tend to invest in just a few businesses a year. It is a high conviction fund, so it's a portfolio of 15 to 20 stocks, and it's really long-term investment. So we get to know management really well. We build strong relationships with management, and where necessary, we'll actually help implement strategic change, and that can involve joining the board as well. So we're not activist investors, but we'll roll up our sleeves where we need to. And yeah, we're really looking to have a better understanding of these companies than most other investments. So in terms of how the fund and the structure, so we are managed by H&G Investment Management, which is a wholly owned subsidiary of Hancock & Gore, and that's a publicly listed company on the ASX. The ticker is H&G. It's a $75 million market cap diversified investment group. It's actually one of the oldest listed companies in Australia with sort of a 120-year history. I'm a director of that company. Our chair is Sandy Beard, who's had a lot of experience in the microcap space, building up the investment group CVC. And it's actually a massive asset to the High Conviction Fund, having the resources of this publicly listed company. It's got $20 million in cash and a really strong investment team. And there's a lot of cross-pollination in ideas. So that's where the High Conviction Fund sits, and a bit of the history there.
Okay, great. And then you touched on management who really know how to run businesses well. I think we got a good example for our first stock we're going to talk about today. So Evolve Education Group. For people who mightn't be familiar with the name, if we just do a very high level first principles, like how does this business make its money?
Yeah, so Evolve Education is it's actually a recent investment fund. It owns 135 childcare centres across New Zealand and Australia. So there's 111 in New Zealand and 24 in Australia. And the company began just in New Zealand, and it had a portfolio of centres that are called lollipops. So these are just everyday early childcare learning centres that parents send their kids when they need to go off and work or just need some sort of freedom at home. But the company's pivoted to acquire businesses in Australia over the last few years and owns some in Queensland and Victoria. And as you touched on, just a bit about the business model. So for those who don't know much about childcare and the business model, it's very simple. So the main costs really of running a childcare centre are just rent and staff wages. So these are obviously pretty fixed for each centre. You need the same amount of rent no matter how many children are coming in. and you also need to pay the staff. So these are the childcare staff, and the revenue comes from both the parent fees when parents are sending their kids there, and also government subsidies. So it's a really well subsidized industry because of how important it is to the economy. And in terms of the key metric, that's really occupancy and the occupancy rate. So it's such a key metric for profitability because, as I mentioned, the fixed costs are very fixed, and they're the main costs. That's the staff and the rent. So you really just want as many kids turning up each day to your center and paying those fees, both from the parents and from the government. And in terms of the kind of what to look for, the best childcare centers have an occupancy rate of somewhere around the 85% plus mark, and poorly performing centers are 60 to 70%. And yeah, those are crucial metrics in the way the business works.
Mm-hmm. And then a bit around the investment thesis around Evolve, why you got attracted to this particular. I mean, there's a few listed childcare kind of providers, and this sector has been, I guess, on the ASX for a while. We've seen various ones come and go and different incarnations of ones. But what particularly attracted you to Evolve over, some of the other options people have if they're looking for exposure to a kind of a childcare portfolio of assets?
Well, as I mentioned, we're always looking for companies that we feel have been overlooked by the market for some sort of reason. It's usually some sort of externality, let's say, or issues with management that kind of are somehow clouding the superior assets of that company. So Evolve was a really good example of that. And there are actually surprisingly few options on the ASX for childcare, and it's a great industry to be in. And a lot of them the other companies might be fairly well priced because people want to invest in them. And Evolve had these kind of external issues, which, as I'll go into now, I think were clouding the inherent value and allowed us to buy shares at what we deem to be a really good discount to the real value of the company. And, the reason why I think it is so undervalued begins in 2014 when the company actually listed. And it listed the equivalent of $8 a share, and the share price today is 75 cents. So it's been a real disappointment to shareholders. And some of the reasons for that was, pretty classic one. Shortly after the IPO, the company had a series of profit downgrades, and this was largely due to declining occupancy rates across the group of centers in New Zealand. And as I said before, that's such a crucial metric for profitability. So the occupancy rates declined from, say, low 80s to around low 70%. So the profit suddenly was just being hit quite substantially. And the reasons for this, it's always very difficult to pinpoint exactly what, but it feels like it resulted from a bit of an overly corporatized model, and what can happen, which is the friction between head office and then the individual centers. And you really need the people who are running the centers to feel enabled and to love. They love doing what they do, but if they feel that friction from a head office that might be very far away from where they're running the business, then they might leave, etc. So those are the kinds of things that led to a poorly performing portfolio. And then, the interesting catalyst was in 2018 to 19, when Evolve had taken such a hit from a share price point of view. It was recapitalized and restructured. And that involved the selling out of the founders of that business and the management, and the introduction as managing director of Chris Scott. And Chris Scott was the former founder and MD of GEM Education. So that's a G8 Education, tickers GEM, publicly listed childcare company. And Chris built that organization up from a few $1 million to $1 billion business. And he sold out in 2014 or so, and was looking to park his money. So he personally invested $36 million into Evolve in a series of raisings over that period of time. And he had this vision that he could initiate a turnaround in the New Zealand businesses, boost those occupancy rates, and then drive an acquisition strategy in Australia, which is an even more favorable place to run a childcare group of companies. And obviously he had that expertise in Australia, having built up G8 Education himself. So when he first came in and became the MD, in late 2019, led to a positive reversal in the company's fortunes. The share price started to go up, and then you have the lovely COVID hits in early 2020, and all that hard work starts to fall apart. And the lockdowns in New Zealand and Australia really hampered the childcare sector. You saw a bit of a boost again as things started to open up, and then you saw the decline again in the most recent wave of lockdowns. So in terms of our investment thesis and why and when we got involved, so we've been following this for a while and met with Chris multiple times. And when Australia and New Zealand had these big lockdowns over the last, say, 6 months, and the price really fell to a level that felt just forgetting about the future, which was not going to be a COVID future forever. It felt like a great entry price around the low 70s. And then it became, when it became apparent that Australia and New Zealand were committed to a COVID strategy of management rather than elimination, it was obviously, it felt like the right time to be investing when the market hadn't necessarily caught on. And the other thing that's really important is, as I mentioned, the childcare sector is so well supported by the government. And that's really because they play such an important role in boosting employment. And this is even more important in this post-lockdown world. And it's such a crucial thing in allowing parents with children to work their desired hours. And it's also really important for female participation and in the labor force. And it's often a lack of access to childcare, which has been deemed the greatest barrier for female labor participation. So in the last budget, the Australian government allocated about $1.7 billion to the childcare subsidies, and they actually brought this forward by 4 months recently. So again, it's just showing that support there. In the private sphere, there's also increasing institutional interest. So Busy Bees, which is an organization that's backed by the Ontario Teachers Pension Plan, they recently acquired 75 centres in New Zealand and 36 in Australia. And another group, Quadrant Private Equity, an Australian group, acquired 150 centres in Australia. And those acquisitions have generally been on a multiple of around 10 times EBITDA. And that's compared to Evolve's current forward multiple of around 5 times. So, there's that big multiple uplift alone. And Evolve has some really good centres, especially in Australia, where their occupancy rates are in the mid 80%. So, from the thesis point of view, given a lot of things coming together, you have really favorable industry dynamics, you have the inherent value of these underlying assets of Evolve, and we felt that Evolve had really been overlooked because they'd had that unstable past. So many shareholders had been in from the beginning and they'd done so badly, and obviously COVID compounding that. So we feel, in addition to that multiple uplift, which can be around 2 times based on this current valuation, we also believe that Chris Scott, who I mentioned, the managing director, who has personally invested so much money into the company, and the CFO who was with him in G8 Education, Chris Saker, who's also invested money into Evolve and is a non-executive director, they clearly both have the experience, the runs on the board to execute the strategy of building up a really meaningful childcare group in Australia. So yeah, we really look forward to joining them on that journey. And firstly in the short term, that multiple uplift, and then in the longer term, the execution of building up a big portfolio in Australia.
And I guess you mentioned subsidies and stuff like that, and the other side of the coin is the risk to the subsidy model. I mean, outside of that, what are some of the kind of key risks? I mean, lockdowns are out of everybody's control. I mean, that's a key operation risk that could present itself again in the next calendar year at various stages in various markets. But risks around it, I mean, I'm guessing in New Zealand and Australia, is there any noises on changes to the subsidy model? I know that gets parents up in arms like very quickly, or reduce rates, or any other kind of things you're watching out for in terms of a risk perspective. That you've mentioned occupancies a lot, so you can keep a close eye on that. But I'm just thinking a few other issues to kind of be cognizant of with Evolve?
So yeah, I think the subsidy part is a really crucial part. So we're following that very closely, and as I said, so far it's a very promising environment for childcare. And I mentioned the Australian government putting that $1.7 billion in subsidies towards childcare, and in a very interesting move, bringing that forward by 4 months. So it starts in March 2022. So that, I think that shows that there's actually quite a lot of push, because it's such a great way to boost employment, and that's very important in this post-lockdown, post-recession world. And I think New Zealand is also in a similar position. Now, of course, there are risks to that model, and we really will monitor them very closely. I think the kind of other shorter-term risk, as you mentioned, is COVID. Maybe not even a short-term risk, but it's who knows how long we're going to live with that for. And any meaningful disruption with new variants, such as we're seeing now with Omicron, and any setbacks to reopening will have an impact. There's no doubt about that. And Auckland, which is where most of the centres of Evolve should I say, just reopened from lockdown. I think it was on Friday last week. So it's still a moving feast, and we'll see how it all goes. There's positive. It's positive that I think it's 88% of New Zealand's eligible population is vaccinated. 94% is partially vaccinated. So it's on the right track. But there's still always potential for new variants to come out, and for it still to spread. So that's definitely something that we watch closely, and I think we're always a risk. The other thing that I'd say is a big risk is the key man risk. And as I say, the two most important things we're always looking for: the first is a really superior business, the second is a superior manager. And we do feel that Chris Scott, as I say, he's got the runs on the board, he's the right person to be backing in this. But that is that key man risk, and if he decides to leave, or if something happens to him, then it ruins the thesis. So that's always a big part of it. We feel comfortable in the sense that he has got such a personal holding in the company, so that makes us feel comfortable. But that certainly is a risk, and also, as you mentioned, the occupancy rate. So there's still a lot more work to be done in the New Zealand business outside of COVID, because of that difficulty before, and that maybe overly corporatized model, which led to the reduction in occupancy rate. So Chris still has his work cut out to improve that, and we really just need to follow that very closely, and that's the key metric there.
Okay. And things I guess that you're looking out for, and other people maybe should kind of keep an eye on as we, let's say, move through to this time next year. Is it more work on the occupancy of the existing centres, or should we be looking at, how Chris is executing the acquisition strategy in Australia, and, trying to, give a little bit of a better balance for, not have it so New Zealand focused, and, try and get the Australian business up into a bit of its own kind of critical mass, or indeed anything else we should be keeping an eye out for?
Yeah, I think the first thing that we really need to see is the trading update, especially post-lockdown. So the last time we heard from the company was in August this year, and that was in the height of lockdowns, and that's when we received the most recent trading update. So I think it would be very important to see how it's going in this post-lockdown world, and as you say, focusing on those occupancy rates. And I think that's a really important thing to be looking out for. The other thing, you also mentioned acquisitions, and there is that stated strategy of acquiring in Australia. I think there'll have to be, a lot of, you'd expect it would have to be some period of things running as normal to feel comfortable to go out and spend more cash on the acquisition. So, we really have to see that things have stabilized in this post-COVID world, but that is a really important catalyst, and rebalancing it so there's more in Australia, which has this really favorable environment. The other thing is, as a corollary to that is, as I say, Chris's focus and his expertise is in Australia. So, there's always a possibility of selling the New Zealand business. And the way we look at that is that's an asset that could be sold. And that would be a major catalyst for re-rating, I think, if that's possible. And, in terms of what you could get for that, this is, just looking at the figures, that the center should be doing something like the $14 million mark in EBITDA per annum. That's in a sort of post-lockdown world without any upside from increasing occupancy rates or so. And that's a center-based EBITDA. And recent sales of these, I mentioned all the private equity coming in and buying some assets have been going for around 7.3 times EBITDA. So assuming that Evolve gets less than that, say they get 6 times EBITDA for their New Zealand business, then that's $84 million that comes in. The market cap at the moment is around $124 million. So that's a big chunk of their whole value. And it would actually leave the Australian centers, which, as I mentioned, are superior centers with really high occupancy rates. It would leave them on a 2 times EV EBITDA. So that's way too low. And of course, that's some serious potential for uplift. And that would also free up a lot of capital to be able to invest into Australia. So that's an interesting possibility, and a lot of the kind of shows the hidden value, I think, in the company.
Exactly. Yeah, well, definitely one we'll keep an eye out as we push into the new year, whether we get a trading update or they hold back until the results actually come out in February. I want to move on to the second one. Actually, a company we had in presenting maybe 6 weeks ago, Ensurance. For anybody who didn't catch the presentation, I think another just high level overview of Ensurance for anybody who hasn't kind of come across that story before.
Yeah, sure. So Ensurance is another company we invested in fairly recently, and I also did see the presentation on Coffee Microcaps. So for anyone who doesn't know it, Ensurance is an insurance underwriting agency. And for the uninitiated, the underwriting agencies are specialist insurance businesses, and they've been given what's called delegated authority to write policies in these kind of specialized lines of insurance, and they write them on behalf of the actual large general insurance houses, such as Lloyd's and AXA. And the reason why Lloyd's and AXA allow groups like Ensurance to do that is because they actually lack the in-house expertise, or they don't really have distribution into certain regions of the world. So, for example, the kind of lines that a big insurance house like AXA would outsource to a group like Ensurance is something like professional indemnity, construction, cybersecurity, terrorism, and sabotage insurance, those sorts of things. So what Ensurance is doing is really, they're the ones who are writing these policies on behalf of these groups. And Ensurance works as a kind of intermediary between the insurance broker, who's like a Steadfast, say, and Steadfast is the one who's finding the clients who want this line of insurance. And then Steadfast knows that they can't deal directly with the Allianz, Axis of this world, so they go to an insurance underwriter like Ensurance, and they write the policy for them. And the beauty of this model is that it's really capital light, because it's the large insurer, the Axis of this world, or the Allianzes, rather than the underwriter, whose actual balance sheet is used for the policies. But instead, Ensurance is writing this. They take a clip of the policies that they write, and that's known as, the policies they write is known as the gross written premium. So they take a clip of that and they charge an underwriting fee for the time spent, reviewing the risks associated with it and setting up the policy. So that's an interesting place that they fit into this insurance world.
And what attracted you to the insurance business? Was it the management involved, or the capital-like model? As you say, insurance businesses are very similar to banks. Huge amounts of capital need to be kept for regulatory purposes. So if you can, I guess, leverage off somebody, a bigger player, and still play in a niche part of the industry, that you only have to look at Warren Buffett. Insurance is a profitable game. When it's done right. I think that's the main thing, and I think going out to specialists, the theory makes sense. But yeah, what attracted you to insurance in the first place?
Yeah, so no, all the things you said, it's a good business to be in, and there's not much exposure in this, which I'll go into a bit more detail. But the real catalyst and things that got me interested were indeed the management and the kind of corporate activity that had taken place in the stock. And a bit like Evolve that I mentioned, it had a pretty difficult start to its existence. It listed in 2011, and the share price fell dramatically from the kind of equivalent of $2 at that time to around the 20 cent mark over 10 years. So it was a pretty unsuccessful one to begin with, but it started off life with different management, and I think it was perceived to be this kind of a bit of over-promising and under-delivering, and this focus on rolling out a fintech insurance platform, and yet still had a core underlying business in this underwriting agency model, but focusing and investing capital in maybe the areas that didn't produce a good return. And so we had a lot of disgruntled shareholders and the usual things, selling out, share price falling, institutions leaving. And in 2018, a successful Australian businessman whose name is Tony Leibowitz joined, and he joined as a shareholder first. If you don't know him, he was the founder of Pilbara Minerals and has had a great career as a director of multiple ASX listed companies. So he invested a lot of his own money, personal and both in placements and on market. And he then became the executive chair of the company and initiated this turnaround. So the old founders left, the old management left. Tony started selling off that, the extraneous fintech business that I mentioned, and really focused on this core asset of building this underwriting division, and specifically this underwriting division in the UK, which was showing really promising signs of growth. And I think, I met with Tony, and he described it as this was his kind of thing to leave to his grandkids. It's such a solid business that you really can leave a good insurance company to the next generation, and it should be paying regular dividends. So he saw that opportunity there, but it required a lot of, gardening to really get it to the right place. So he did that over a few years' time, and over that period, the gross written premium in the UK organically grew by 83% per annum. So it's, it was really good growth, a good management team there. Of course, it was off a relatively low base, but things were going well. And last year, a pretty crucial inflection point occurred when that UK division recorded its first profit. So that's when we started looking at the business, and it also triggered a few other positive signals for us. So the first was, as I mentioned, that Tony had been buying a lot of stock on market and had really been personally invested in the company. And the second was a new substantial shareholder coming in, whose name is Tom Kent. And interestingly, digging a little deeper into who this Tom Kent was, he himself owned an underwriting business in Australia, and he had just bought on market something like $2 million worth of stock without any association with insurance, but he just saw that it was a great opportunity. And he actually been buying them at a premium to what the current market has been. So our rationale was, if people in the industry thought this was a great opportunity, who really know underwriting well, then there must be something to it. And then the next interesting inflection point was that this man, Tom Kent, who owned this underwriting business in Australia, agreed to merge his business into insurance, and he received just scrip for it. So he really believed in building up, and still does believe, building up this specialty insurance underwriting business. And this all occurred actually in July this year. So it's a very, very recent inflection point. And it also really helped to bring necessary scale to the business. So you have that UK division, which has just reached profitability, and you have this Australian division that Tom Kent had built up and was actually profitable already on its own. So I think that was a really interesting turn of events to happen. And actually, just in the last few days, Tom Kent has become CEO of insurance as a whole. And I think this is really positive, given his expertise in the industry and his personal investment. So it really goes to our investment philosophy, which is these superior underlying businesses coupled with management who has very good experience and real skin in the game. So fits that. And insurance has, at the moment, three, I think, very clear priorities and a clear pathway to continued growth. And the first one is that they can distribute the UK's products into the Australian broker base. And that's because, as I say, you need to, as an underwriting agency, to have delegated authority from a large insurance house. So the UK business has authority from AXA to write policies on its behalf. And the Australian business also, the one that Tom had started and founded, also has that authority from AXA. So it makes it quite easy to be able to bring that over into Australia. The second one is they can organically grow the existing portfolio in Australia, and they're opening an office in Sydney very shortly. Actually, I think in January, 2022, and it's being headed up by a former AXA insurer. So it's a really positive step. So that's that organic growth. And the third thing is the accretive acquisition. So that can be in probably, I think they're going to be focusing on the Asia Pacific region. And the interesting thing is that there are some bigger players in Australia. There's AUB and PSC and also Steadfast, all, even though they're all brokers, they also play in this insurance underwriting space, and they buy up some businesses, but they're multi-billion-dollar businesses, so they're looking for much larger ones. Whereas insurance's market cap is 20 million, so they're going to be hunting in a much, almost completely unsought after area in these smaller insurance underwriting businesses. So a lot of potential there. The final thing is just the industry as a whole. Insurance premiums are actually globally on the rise. And it's for a multitude of reasons, but it's a positive time to be in this insurance space. And we feel in a growing market that's worth probably over $10 billion. That's just the underwriting market in Australia and the UK. Insurance at a $20 million valuation has enormous upside to be able to grow into that. And the other thing is that these insurance underwriting agencies are usually valued by the market. And this is quite a lot more evident in the UK, where there's a more mature market. They're usually valued at about 60% of their gross written premium. And insurance's gross written premium is about $50 million, let's say, for the year. And this would, at a 60% level, value insurance at 36 cents per share. So that's actually 50% above the current share price. And that's without the prospect of significant growth for the reasons that I mentioned. So it's a unique combination of both being a value play, because you're actually buying it probably at a discount to what the market might pay for it elsewhere. And it's also has this significant potential for growth because it's starting from a low base, and it's in an area that not too many other people are in the smaller end of town. So the final thing of interest is that it's the only pure play underwriting agency that's actually listed on the ASX. And as I mentioned, some of the other bigger names, they're integrated, so they have a broking house and an underwriting house. But it's quite a benefit to be only an underwriting agency because you're independent, and a lot of other brokers might want to use you. As I said, it's a capital light business, steady stream of cash flows. And we feel that we are quite excited to participate in this long-term growth, both value uplift in the shorter term, but then this long-term strategy that Tom Kent is starting to do of really building a meaningful underwriting business listed on the ASX.
And in terms of risks for a business like this, is it that they do poor underwriting and they lose the delegated authority from whether it's AXA or Alliance or Lloyd's or whoever it might be? Is that like one of the major risks, that with these specialty lines, you got to have a very deep understanding of what you're actually underwriting? Is that kind of the key risk, that they lose a relationship with one of the major houses?
That definitely is probably one of the biggest risks. As said, it's not their own balance sheet that they're risking, so that's a great thing from the perspective of shareholders, that it's limited how much you're going to lose. But on the other hand, you are only as good as the policies that you're writing. So if you have this delegated authority from AXA and you keep writing terrible policies, then of course they're going to cancel that authority at some point and can you. So you're really relying on expert management, and it's a goodwill business in that sense. It's based on the relationships that the people running it have, and the continued success of writing good policies. So definitely one of the biggest risks is that, and to that end, you're really relying on the people who are running it. And that's, the key thing for us in this case. It's, as I mentioned, Tom Kent, who's now the CEO. It's his responsibility to ensure that they're writing sensible policies. And there's some sort of solace in the fact that, as I mentioned, he's invested personal cash into the business as well as receiving scrip for the business that he built up. And so that lets me sleep a bit better at night, that his kind of risk profile and desire for pure growth at the expense of running bad policies would probably be diminished. And on the UK side of things, the CEO there has decent performance rights and some stock. So there's some solace there. But you completely spot on that is it's definitely the biggest risk. I think some other risks is the old, I mentioned it before, but just lockdowns, of course, impact business. And we saw that last time. In the heart of the pandemic, the insurance industry was definitely hit. And in the UK, they're doing quite a lot of construction lines of insurance. So that's always a risk there. I think there's also the execution risk, because it's in growth stage, and it's they've got to open this new office in Sydney, and they're looking at future acquisitions. So there's always that potential. And Tom that's Tom's responsibility. Very lucky to have Tony, who's a very experienced businessman, on the board as well, helping, because it's going to be about really making good deals going forward. So yeah, those would be the main risks that I see for insurance.
Yeah. And then things, I guess, to keep an eye on as we move through the next 12 months in this business. Are you more looking at how the Australian and UK businesses underlying are going, or is it okay? Can they start bringing in acquisitions to build up scale on top of the organic growth that they're seeing?
Well, usually for our investments, we're very focused on the businesses themselves, and the acquisitions can always be a great upside. They can also be risky. So in our thesis and in what I'm excited about for the next 12 months is more on the underlying businesses. And I think that both the UK and Australia are at these points where they're actually in quite strong growth profiles. And so want to see the UK continuing to increase its gross written premium each quarter, which it's been doing over a kind of 3 or 4 year period. And we also would like to see that happening in Australia, both from the existing business that Tom brought in, but also starting off this new business in Sydney. So that's really going to be an interesting thing, is how do they go with that East Coast expansion, not from necessarily buying new businesses, as I said, but from starting off new offices there. And so that's a really crucial thing to be monitoring. As I said, they're opening that office in January 2022. So we should get the first little bit of idea by the end of the March quarter. And they do quarterly, so it's pretty good to be able to get very easy to get a regular update of how the business is going. So yeah, the thing to really focus on is this continued growth, organic growth in gross written premium. And that's, for me, that's the key indicator for a company like this. And of course, as you mentioned, any future acquisitions, if they're done really sensibly, of underwriting agencies in the Asia Pacific region, could add some really good upside. And the benefit to that is you're bringing these very small businesses, maybe just a few people running an underwriting agency in a really specialized line of insurance, bringing them into a listed environment, you get a pretty good multiple uplift, especially because there are no other companies focusing on these smaller underwriting agencies. So I think those are the main catalysts to be looking at over the next 12 months. And it's really, for me, the focus is that continually increasing gross written premium.
Great. Joe, thank you very much for joining us. Two very interesting names. I think ones that are definitely flying under the radar. And we'll keep an eye on them. And if anybody wants to find out more about the fund, what's the best place they should go? Should it be to the website or to the H&G website, or where should they look up?
Yeah, so you can go straight to the fund's management website. So that's hancockandgoreim.com.au. And people can also email me anytime, Joseph Constable at hgl.com.au. Always willing to and keen to have a chat, discuss stocks, discuss the fund, discuss the economy in general. So yeah, definitely get in touch anytime.
Okay, Joe, thank you very much. And yeah, we'll follow the two stories as we move into next year.
Sounds good. Thanks very much for having me, Mark.